Before we get into anything financial, I want to take a moment to acknowledge what's happening in the Middle East. War is a human tragedy. The Iranian people are experiencing loss and displacement in ways most of us cannot fully comprehend and hopefully never have to. And American service members and their families are carrying that cost as well. So before we talk about portfolios or markets, that deserves to be said first. If you've been watching the news, you probably have had a thought like this. Is this going to affect my retirement? And that's an entirely fair question. So let's talk about what's actually happening underneath all of this. A meaningful portion of the world's oil supply moves through the Middle East. And when that flow is disrupted or even threatened, energy prices are going to rise. We've already seen oil prices move sharply higher. And when energy prices rise, that doesn't stay contained. It ripples everywhere, and it shows up in things like transportation, goods, services. So yes, this can create real economic pressure, and you're not imagining that. But here's where I want to slow this down a bit, because this part matters more than anything else I'm going to say. This kind of event is not new. It may feel new, may feel different. They always typically do, but markets have gone through this before. There's been world wars, terrorist attacks, regional conflicts. Every single time there's an initial shock. And the markets react quickly because they don't know how to price the uncertainty yet. But then something starts to happen. The reaction starts to settle. I think about this like a ping pong ball. You drop the ping pong ball on the table and the first bounce is the highest. Then the next one is smaller and then smaller again until eventually it stops. That's how markets process events like this, not instantly, but over some undetermined period of time. So the question isn't, what should I do about the war? The real question is my plan built to handle moments like this? And this is where people tend to get into trouble, because when things feel uncertain, there's a strong urge to do something, to fix it, protect it, take greater control over it. Wall Street understands this all too well. So what shows up? Products that promise certainty, protection, limited downside. And they sound fantastic, especially right now. But here's the truth. Those products are designed to be sold into fear, not necessarily to improve your long-term outcome. I've been doing this for close to 30 years, and I haven't seen any of those strategies consistently deliver better results. They just make the people feel better in the moment. So what actually matters right now? It's the fundamentals. And I don't mean that in a super simplistic way. I mean that in the most important way possible. Your mix of stocks, bonds, and cash. Not what the market did over the recent history, but whether your allocation still matches what you can tolerate, what you actually need, and the life that you're trying to live. If that's drifted, rebalance. If it hasn't, there may be nothing to do. And that can be the hardest thing for people to accept sometimes. Now, here's another layer to this that gets missed all the time, and it matters just as much. Even if you have the right mix of stocks, bonds, and cash, you still have to ask, am I actually diversified? Because here's what I see over and over again. Someone says, I'm diversified, I own stocks and bonds, but when you look under the hood, most, if not all of it, is stock exposure to one specific area. And most recently, that's been to the United States and the technology sector. And it makes sense as to why. Over the last decade, US stocks, especially technology, have done very well. So what happens? People hold on to what's working, those positions grow, they become bigger and bigger parts of their portfolios. And on the surface, that feels like success. But underneath, it's creating more and more concentration, which means that if one area starts to struggle, you can feel it. And sometimes a lot more. We've seen this movie before. Go back to the early 2000s. Technology dominated the market during the rise of the internet. And when that bubble burst, it didn't hurt just a few stocks. It pulled down entire portfolios because so much was tied to that one area. And today, we're not in the same situation, but it certainly rhymes. Technology, now driven by artificial intelligence, has again become a major driver of the US stock market. So even if you're investing in an index, you may have more exposure to that one area than you may realize. Now, zoom out for a second. The United States makes up roughly 2/3 of the global stock market. So yes, it makes sense for a meaningful portion of your portfolio to be there. But that also means about 1/3 of the global opportunity exists outside of the US. And this is where I see a gap. A lot of portfolios have very little exposure to international markets. Why? because for a long time they didn't perform as well. So people moved away from them and they stayed with what was working. But here's the issue. No one knows which part of the world will lead next. Nobody. And different regions take turns, and that happens very subtly over time. So diversification isn't just stocks, bonds, and cash. It's making sure that within your stocks, you're not overly dependent on any one country, sector, or one type of theme. A simple way to think about it is like this. You have two people, both with 50% stocks, 50% bonds. And on paper, they look identical, right? But one has all of their stocks in US tech, and the other is spread across the global market. So if technology struggles, those two experiences will feel very different. One takes the full hit, the other has other parts of the portfolio helping to offset it. And that's what diversification is. It's not exciting, it's not going to win any short-term performance contests, but when the world gets uncertain, like it is now, it's one of the things that quietly ends up protecting a portfolio. Now, if you're retired, this becomes even more practical. Where is your income coming from? Because if markets are down, you don't want to be forced to sell stocks at lower prices just to fund your life. That's where bonds and cash come in. They're not here to maximize return. They're here to give you options so you can meet your expenses without disrupting the long-term part of your portfolio. And that's not just theory, that's protection. So if you're feeling unsettled right now, that doesn't mean that something is wrong. It just means that you're paying attention. But reacting to that feeling, that's where mistakes tend to happen. So let's take a step back, not from the world, but from the noise. And let's come back to the plan, not headlines, the plan. Is it built to absorb something like this? Can it be flexible? Can it carry you through these periods of uncertainty? Because this won't be the last time the world feels unstable, because it never is. And the goal was never to predict these moments. It was to be prepared for them. If you want help thinking through your plan, or you just want a second set of eyes on whether it's built for moments like this, that's exactly what I do. But either way, don't let a moment like this push you into a decision that your future self has to recover from.